Today's topic, I'm going to discuss retirement annuities and go over in depth the pros and cons of a retirement annuity, why somebody would ever use an annuity, and more importantly, the mistakes that are made when somebody's trying to use an annuity the wrong way. So before I get started, realize that an annuity is a type of insurance account that an individual could use like an individual tool in a tool belt. They're using this specific type of account to help them accomplish something more effectively, something more efficiently, based on what their risk tolerance is, based on what their income goal is. And when doing so, what happens is individuals get caught up in the shiny object. They get caught up in these income rider roll-up rates and these bonuses and different things that can lock a person into a contract for too long and not give them enough growth, meaning that it's not going to give them enough flexibility to accomplish their goal successfully. So with this video, I want to show you kind of the inner workings of how you could use these effectively and then where to avoid them. And then if you are interested in leveraging an annuity, how to make sure that you're placing the smallest amount of dollars in there and only as much as necessary so you can have as much leftover dollars as possible towards your fund monies, towards investments, towards really whatever you deem ideal for your situation to accomplish your goals. So the two main areas why somebody leverages a retirement annuity is for income or for accumulation, or a combination of both. So from an income side, what do I mean by that? Well, what typically happens as an individual, with financial planning, it could be broken down into two parts. You have a wealth accumulation phase, and then you have a wealth preservation and distribution phase. So when somebody's working or they're starting work, what are they trying to do? They're trying to take their monies, save their dollars, save any excess dollars beyond their expenses as they're working, and place that into employer-sponsored plans, individual type accounts, and they're making contributions into these retirement plans or into these retirement savings buckets. So as they're making contributions into the plan, that's one way on how that bucket grows or how that account grows. And then the second side of the coin is a rate of return. So like as an example, let's say somebody's working for a private institution and they say, okay, I'm going to place 5% of my salary into my 401k account and my employer is going to match me 3% of my salary. So if somebody was making $100,000 as an example, and they put $5,000 into their bucket, into their 401k account for that year, the employer is also going to be adding $3,000, which is 3%. So you have $8,000 going into this bucket on the contribution side, but it doesn't stop there. On top of it, they're trying to leverage investment opportunities. They're trying to leverage the stock market or how they set up their allocations to say, okay, not only am I adding contributions to this plan, but I want this plan to try to accumulate as much as possible, so I'm going to leverage the market to do so. So what's occurring is if somebody's super aggressive and they leverage their monies towards the market, they're going to go and let's say the market picks up and does very well for that year, where they're going to have the positives that they added from the contributions, the positives from the rate of return, so this bucket's going to grow fatter and fatter and fatter the further they're able to pick up on these positive growth rates through those investment accounts. The reason why I make that example is that's during an accumulation phase. So individuals are trying to place as much money into those buckets, whether that be a 401k, whether that just be a regular brokerage account. They're using non-qualified monies like cash monies, or they might be setting up IRAs, SEP IRAs. There's a whole multitude of different things on how somebody could leverage specific accounts geared for retirement, or they just keep pumping money, more and more money into their business. And they're eventually going to be selling their business later down the road. This is all part of wealth accumulation strategies. They're trying to accumulate that wealth. So what happens is they're able to take on more risk because they have a longer time horizon that if the markets hiccup and it goes down, they're allowing time for those markets to go back up. So as an individual keeps working and they keep living and living and living and they accumulate more and more dollars, they're accumulating, well, they're getting closer to that point B. If let's say they started at point A when they started working and they started making money, where their point B might be their ideal retirement date. Well, as they start getting closer, they're running out of road. They're running out of time frame to allow those investments to go down and then try to, pick back up, because if that happens towards the end of the road, it could be complete devastation. That could be a retirement disaster on their hands. So what individuals try to do is as they start nearing that retirement date, they try to preserve their money. So rather than take a really aggressive approach, they try to preserve those monies and then understand that, okay, when I'm no longer working, I'm no longer bringing in a paycheck from work. The only other income source that I could really rely on might be Social Security income. And if I'm lucky and I'm offered a pension plan, because majority of individuals are not, that used to be the norm back in the day, but no longer it's not, then maybe you might have pension income as well. These are two cash flows. These are two income sources that'll be coming to an individual where they're no longer working, but it's some sort of distribution, some sort of lifetime income stream that's coming to them. So now they have to rely on all those little buckets that they've accumulated by the time that they hit their retirement years to say, okay, well, I don't want to take a large market hiccup because then that's going to reduce the amount of money in my bucket, and I need this bucket to grow and to be leveraged for income most when I hit that point B from my retirement date, because I'm no longer working, until me and my spouse live for the rest of our life. If we live to age 100, if we live to age 75, if we live to age 85, really whatever that is, it's basically date of death. So how can I do this most effectively? This is where an individual can leverage a retirement annuity to produce a lifetime income stream. Something that they're giving X amount of dollars to an insurance company, it's in an annuity account, and you could leverage this through, think of this portion over here, this bullet point, as individual buckets: non-qualified bucket, traditional IRA bucket, Roth IRA bucket. If somebody's accumulated monies, they were part of their wealth accumulation strategy was they were placing monies in cash accounts, checking accounts, savings accounts. Maybe they sold a house, maybe they sold a business. These might be lump sum dollars that they can leverage for an income related strategy. Same thing, traditional IRA. Maybe somebody leveraged their retirement account, such as 401k or 403b, thrift savings plan, 457 plan, and then they rolled it over into a traditional IRA. That's how you could leverage a traditional IRA retirement annuity. And same thing with a Roth IRA. If somebody was accumulating Roth IRA monies, meaning that if you're triggering income from an annuity in a Roth IRA, it's going to be coming to you tax-free monies for the rest of your life. So these are obviously these are the different types of monies that you could place into these accounts. And that's where individuals think, like, automatically, if I have my money in an IRA, it has to be set up in investments. And that's not the case. You could go and set up an IRA or a Roth IRA or non-qualified account. You have a whole multitude of different ways on how to set that up, how to structure it. Some individuals might want to just set it up in a fixed account. Some individuals might want to set it up in an aggressive account with different investments. Some individuals want to set it up with an income-related account, such as an annuity, or a safe accumulation account, such as a market-linked CD or a fixed index annuity or something like that that will give you growth without that sort of income mechanism, attached to it. Just something that's trying to grow it on a safe, consistent basis. So once again, there's a whole slew of different options. And this is where I want to make sure that you're understanding, okay, why would I want to use it for an income play more effectively than just leaving it into investments? Or why would I want to use it for an accumulation play as opposed to leaving it into investments? And, there's no right or wrong answer. There's no, okay, place everything into this one product and that's it. It's okay, how much should you leverage towards that one product while leaving your other monies towards this other area of growth? So if somebody needs to complete an income strategy, the common mistake that's made is they'll leverage a growth-related account because that's what they know. They knew that when they were working, they were part of that wealth accumulation phase. So they're hoping that same wealth accumulation strategy would work throughout retirement. What we've seen, and there's different publications out there, is you want to leverage income-related strategies. You want to leverage, whether that be income laddering strategies or lifetime income riders, different things that could produce a higher cash flow, a higher lifetime income cash flow than staying with a growth-related strategy and trying to peel off monies while avoiding downward market losses, avoiding fees. And that's the big takeaway, is when somebody's leveraging a growth strategy, the risk that comes with growth strategies is the most important one is going to be downward market losses. So if you put yourself into that future, your future self, when you are 65 and you say, okay, I have this $1 million nest egg that's basically sitting here. If the market takes a shift and you have a 20%, 10% drop into that account, that's going to scare the shit out of you. That's where you want to be careful with saying, okay, if the market drops, I'm not only having the downside of the market loss, but then on top of it, I'm paying sub-account related fees. I might be paying expense ratios. I might be paying a financial advisor that's tacking on an extra 1% to 2% to quote unquote manage my account. And on top of it, I'm pulling out income from this account. So all of these are negatives. You have the power of compound interest that's working negatively against the account, because unlike when you were during your working years, what was happening? You were adding contributions into this bucket and you were getting a rate of return. Well, when you're no longer working, you're no longer adding contributions to that plan. So now you're relying solely on the rate of return. If the rate of return comes back negative in a given month or in a given year, and you're pulling monies from that account, and you're getting dinged with expense ratios, and you're getting hit with those financial advisory fees, those are all negatives. Those are all individual holes in the bucket with the downward market loss being a slice of the bucket. So this is where somebody could leverage a retirement annuity, specifically ones that are geared for lifetime income streams, whether that's you're leveraging an income rider, you're leveraging some sort of lifetime income mechanism to say, okay, rather than me take a chance, rather than me risk my monies, let's go with more of a conservative play. I understand that if I put X amount of dollars in with this retirement annuity, and let's say it's in an IRA account, that will give me X amount of dollars of cash flow. So I don't have to use up my entire nest egg. I only have to use up the correct portion, the smallest dollars, only as much as necessary to accomplish what my expenses are, what my expense gap is. As I clear up the screen, I go through something known as the three-thing scenario. I try to cover it on all my videos, and I just think it's a way on how somebody could conceptually realize how to properly retire. And there's three things. There's three things that every individual needs to figure out before they're retired, or if they're currently retired, how to stay retired forever. The number one thing is income. The number two thing is emergency. And the number three thing is growth. I'm not saying that somebody should go and take all of their monies from a wealth accumulation strategy and place it all into an annuity. I'm saying if there's a specific reason for an annuity, you should be able to leverage it. You shouldn't run from it because you have a warped misperception on how an annuity works. Some annuities could be set up for income. Some annuities could be set up for accumulation. And sometimes annuities it does not make any mathematical sense to leverage it. It's based on your risk tolerance. It's based on what you're trying to accomplish. So what I mean by these three-thing scenario is, let's give the example that somebody has $1 million of their different buckets. They have a portion of non-qualified monies, portion of traditional IRA monies, portion of Roth IRA monies. This individual is currently age 60. He wants to retire at age 65. He's eligible to take his 401k monies and roll those over into traditional IRAs, so that's why I'm just going to keep it very simple with this example. And we understand, after doing budgeting analysis, that this person at age 65, so this is technically his point A. His point B is age 65. And we need to make sure that he has $80,000 of cash flow to accomplish his expenses each year going forward from age 65 until date of death. If he lives to 120 years old, we want to plan for that. If he lives to 80 years old, we want to plan for that. We don't want to say, okay, we'll feel like you should be pulling out this much money, and we're going to show you all these projections of having you live to age 87, because, that's typically what a male should be living to. Well, what happens if he's in perfect health by the time he's age 87 and he could live for another 10 to 15 years, which might sound insane in today's times, but with technological advances, that could be a realization. You can't take anything off the table because with retirement planning, you only have one chance to get things done correctly. If you mess up, what's the negative? What's the worst case scenario? The worst case scenario is you're going to burn through all your money. You're going to have to potentially go back to work, or you're going to have to rely on your family members to help pay for your expenses. You're going to have to move out of your house. Who wants to do that when they're already comfortable and they've been living the retirement of their dreams? So this is where the income, in my opinion, is one of the most important aspects. This is really your safety net. So on how to figure this out, if we know that this individual has $80,000 of a cash flow need, of an expense need, and maybe they have $40,000 of Social Security income, and then maybe another, we'll call it $20,000 of pension income. He's fortunate enough to have pension income. Well, then this tells us that they have $60,000 of some sort of lifetime income cash flow. Well, the need is $80,000, and that's not even incorporating inflationary step-ups. We have a $20,000 gap there. There's $1 million that's sitting in this account. How can we leverage, at this age 60, we have a 5-year time horizon, maybe out of leveraging that $1 million, it's going to cost $200,000 to get placed into the correct, let's say, IRA account with a lifetime income mechanism, with lifetime income rider, that will produce this individual the $20,000 of cash flow needed at age 65. Out of that $1 million bucket, instead of using the full $1 million and hoping that the market's not going to go down, we already preserved the account because we leveraged the top retirement annuity that gave a highest possible cash flow to that individual. If this person keeps living, all of a sudden passes away, and there's still an account balance in there, that account balance would get left over to beneficiaries. If the person keeps living, and they drain through this $200,000, and they hit that X point of no more dollars in their account value, well, the insurance company's still on the hook to keep paying that $20,000. So if the person lives to 100 years old, 110 years old, some sort of crazy situation, they're still protected because they're receiving the lifetime income from the annuity, they're receiving the lifetime income from the Social Security income, receiving the lifetime income from the pension income, and that will suffice their expenses each year going forward. Now, what we did not use out of that $1 million bucket, now we could maybe leave a portion of dollars towards an emergency need. Rule of thumb is an individual should leave anywhere between 6 to 12 months of what their expenses are into just a liquid account, meaning that they can easily access it. So maybe out of that $800,000 remaining, they go and they leave $50,000 into a money market account, a checking, a savings account. And then that will accomplish step 2. And now, what happened? Well, out of that $1 million, we accomplished step 1 with $200,000, we accomplished step 2 with $50,000. Now we have $750,000 that this individual can leverage towards a growth-related need. They could go and say, okay, I want to use this and go gung-ho into the market. Just completely go into an index fund, be super aggressive, mess around with individual stocks and have some fun with it. Because even if the 750 drops down to 500,000 and then it swings back up to $1.2 million and goes past, $2 million, that's fine. This is going to ebb and flow. This could still create that wealth accumulation strategy. Because we have that safety net to say every year your need is to make sure that you're accomplishing that $80,000 of cash flow. So how can we get there the easiest possible way using the smallest amount of dollars to do it? So that's really the trick behind the 3-thing scenario. And there's a couple other moving parts. Obviously, we want to incorporate for inflation. We want to incorporate for net income, meaning how the taxation works with that, how taxation works with Social Security income. So there's some nice little tweaks to make, and that's something that we do more in-house, that we help individuals out. So at any point in time when you're reviewing this video, you have specific questions, give our 1-800 number a call. It's 1-800-566-1002. And you can reference this video, and we'll make sure to deal with, have you set up with a specialist based on what your calendar is, what time works most suitable, date and time works most suitable for you. So that goes over the difference of, or how somebody can leverage a retirement annuity for income. It's a very effective route. You can make sure, some of the different knocks on annuities is saying, oh, well, it has high fees. Well, it depends, because you have some companies that don't have any fees with their income streams, with their income riders. You have other companies that do have high income streams. So that's where really, when I'm going to go over the problems with it, I'll show you kind of, what makes an inferior product versus a superior product. But for the most part, if you're looking at it as a game of leverage, you're looking at it as an individual tool. Think of if you're trying to hammer in a nail. Are you going to use a hammer, which is going to be most effective, most efficient? That could be an income-related strategy, an income-related product such as annuity. Or are you going to use the back of a screwdriver? And that might be an investment, a growth-related need. The back of the screwdriver could still do the job. It's just not going to be as effective as an efficient. Just like if you're trying to use a growth-related account, don't use an income-related product to do it or an income-related strategy to do it. There's no reason. Say, oh, okay, I feel great. I'm just going to have more and more income. Well, and that's really the trick of leveraging budgeting analysis. One of the things we try to help out individuals is really create that finite number to say, okay, what are your expenses right now? What are your expenses projected to be? Are you going to still have a mortgage in the next 5-10 years? When is that mortgage going to drop off? So all these little calculations, it builds out that perfect picture in retirement so that you can be structured. And really, when you're the more structured, more prepared, it's going to alleviate stress throughout retirement, so it allows you to be happy and actually have that retirement of your dreams, have that retirement that you've been, wanting since you first started work, depending upon how much you like or dislike your job. The other way on how somebody could leverage a retirement annuity could be through an accumulation phase. So you could leverage this with fixed accounts. You could leverage this with fixed index accounts. You could leverage this with variable accounts. A variable you have to be very careful with. Basically what happens is whether you're leveraging like non-qualified monies, traditional IRA monies, or Roth IRA monies, they're going to grow with the power of compound interest when it's set up in an annuity chassis. So with a fixed account, let's say if a typical bank CD is paying 1%, a typical fixed annuity might be paying 3%. With that bank CD, if let's say you're using cash monies, non-qualified monies, and you're paying 1%, you're going to have to pay tax each year on that 1%. So if you put $100,000 with a fixed annuity, with a bank CD that was only paying you 1%, you're going to be receiving $1,000 of interest, $1,000 of interest, $1,000 of interest. It's always going to be on that original $100,000, and you're going to have to pay a 1099 because that was a type of gain each year off of that interest. With a fixed annuity, if you gave $100,000 and let's say you're getting 3% rate of return, if you, let's say you didn't pull out any money you're not getting taxed on those dollars. Everything's growing tax deferred. So the next year, it's sitting at 103,000. The next year, it's 3% of 103,000, which brings it to 106,090. So these little micro interest amounts that you're getting, so that if you fast forward 5 years, you can have a much larger account balance because it grew with the power of compound interest that's in there. So that's the way that a fixed annuity would essentially work, and individuals could leverage that as accumulation play. If they're just saying, hey, I don't want to have any downward market losses. I just want to make sure that I'm getting just a safe 2-3% of my monies, potentially 3.5% based on what the current interest rate environment is. The higher the interest rates increase, the better that fixed annuity options will be. Same thing with fixed index annuities. Fixed index annuities gives you a little bit greater potential for a gain, but it's going to only give you a gain whenever that market index that's linked to it increases. So it's that same sort of concept. You're going to have a starting point and an ending point. So maybe it's going to be a 1 year point to point where an individual could be set up with a fixed index annuity, and it says, okay, whatever that index is going to gain, you're going to get 90% of whatever that index gain is. So let's say if the index gains 10%, you're going to get a 9% credit into your account after the first year. The next year, let's say that the index loses 10%, well, then you're going to have a floor of 0%. So it's going to give you a floor of 0 and then a growth up to, whether it's an uncapped index, whether it's a capped index with a high cap. So there's a whole slew of different ways on how to do it, but just be mindful that the concept of a fixed index annuity, it's going to gain when the market goes up, not lose when the market goes down. So individuals, especially with the current interest rate environment, as interest rates increase and the Fed keeps increasing interest rates, individuals are leveraging these types of fixed index annuities as a bond alternative to say, well, if I'm in regular bond related funds and interest rates are increasing, that might put a negative to my bond portfolios. So individuals could leverage a portion of their monies towards a safe accumulation play, meaning be aggressive with a portion of their monies and be conservative in placing those in the fixed index annuities with shorter term accounts to just say, I know worst case scenario, I'm going to gain 0%. Best case scenario, I could get a double digit return. Realistically, because they're safer, they're not going to give you as high of a rate of return as what a regular, investment related account is. So be mindful of that, but you're using it as its individual tool. You're just using it as a safe accumulation play to say, I want to have growth when the market goes up, but I don't want to lose anything when the market goes down. I want to have no fees, no downward market losses with those accounts. So that's what explains a fixed index annuity. Variable annuities, individuals should be careful with those. It depends on what sort of variable annuity. The big problems that we see is individuals leveraging variable annuities with income riders attached to it. And this explains, in my mind, a duck boat. So if you know what a duck boat is, it could drive on land and it could go into the water. It makes a shitty car and it makes a shitty boat. It's a hybrid. Variable annuities basically make a shitty investment and it makes a shitty income play. You could leverage variable annuities if you don't have income riders attached to it, meaning no load variable annuities. And that could be suitable for, let's say, an individual that says, I have non-qualified monies. I want it to at least grow into the market. And I want to make sure that I'm not taxed with capital gains rate every single year that I'm doing a buying and selling of trades. So you could keep it within an annuity chassis, a variable annuity chassis, but it's no load, meaning that you're stripping away all those unnecessary fees that a typical variable annuity has when it has an income rider and a death benefit rider and all these different mechanisms. And also, if you want to pull all of your monies out, you could do it at the drop of a hat. You don't have a decreasing surrender schedule. So that's where variable annuities could be very effective. I'm just going to graze over on the variable annuity side, but this is for individuals to just say, I want to grow my monies. I know that I'm not going to really be touching these monies, so I want it to grow with the power of compound interest as opposed to in a brokerage account where every time I'm doing a buying and selling of trades, I'm going to have to pay a capital gains tax on it, and it's not going to allow me to leverage the power of compound interest. So that's where a variable annuity could be suitable. But if you have questions on this, on which route to go, once again, feel free to give our 1-800 number a call. I can explain that more in depth, really based on that individual situation. So you heard me talk about a lot of good things about the retirement annuities, how you can leverage that towards different individual tools in the tool belt. What are the problems? The first problem is annuitization. These were old-fashioned annuities. So what would typically happen is, if we have an example, somebody has $100,000, they go up the road to their local insurance company and they say, hey, I have $100,000. If I was to give it to you, how much could I receive of lifetime income? They look at it, they'll do their little calculation, say, okay, we're going to give you back $5,000 per year. So this individual surrendered $100,000 to the insurance company. They're receiving $5,000 back. Let's say this person only lives for 3 years. They would have received back $15,000. They would have passed away, and now the insurance company kept $85,000 of that person's money. Nothing got left over to the beneficiaries. So that's a very simple way to explain an annuity. There's little things. You have joint income. You have joint and survivor income, similar to how like pension plans work. But for the most part, you're losing control. That's why annuitization is a very bad thing. You had insurance companies, and the first ones that came out with it were variable annuity products, and then you had fixed index annuities that stole that concept, known as an income rider. So what I mean by that is a fixed index annuity. Let's say somebody's going with the top fixed index annuity in their specific state, rather than leveraging the local one up the road. They could go and say, okay, well, if I have $100,000 and I'm going to the top fixed index annuity with an income rider, maybe that index annuity could give them 7% cash flow. So now they're receiving $7,000 of income. Their physical money is going to be gaining, like how a regular fixed index annuity works, is gains when the market goes up, doesn't lose when the market goes down. And the negatives could be an income rider fee, if there is an income rider fee on that specific one that comes back in first place, and then also whenever they're pulling monies from it. So let's just say that there was no fee on the income rider, and there's persons pulling out $7,000, and let's say they lived for 3 years, unfortunately passed away, and let's just say there was no growth. Keeping all things equal, there was no growth in their account from upward market gains, just the market was crashing each year for those 3 years. So we know that $21,000 would have came out of this account. 7,000 multiplied by 3 years, 21,000. This person passed away, they would be able to leave $79,000 to their beneficiaries. So they were able to receive a lifetime income stream and also leave money to beneficiaries. Let's say if this person keeps living and living and living and living and living, let's say they live for another 20 years. Well, they would have given $100,000 to the insurance company. They would have had that protection that if they passed away, whatever's remaining in the account balance would still get left to beneficiaries. But let's say because they lived so long that they would have exhausted all their monies and their account balance would be sitting at $0, the insurance company is still on the hook to keep paying them the money. So they would have leveraged $100,000 into the correct product. They would have received back $140,000 of income before they passed away. So that was a good mathematical move. They were using their longevity. They were using how long they were going to be living to their advantage with the law of large numbers with the insurance companies and those specific contractual guarantees that the insurance company was setting up for that specific cash flow need. On top of it, the cash flow with income riders is typically higher than cash flows through annuitization. So that's why it's important to leverage the top product, a superior product that's in that person's situation, that's specific to that person's situation. So based on what their age is, based on what their sex is, based on what state that they're trying to get set up in, all those different factors come into play. So I hope that makes sense, and that's a very large mistake that individuals make, or a misconception that individuals have, is all annuities can only be leveraged through annuitization. That's not the case. Especially after 2000s, the innovations to these things just keep getting better and better from an income perspective and even from an accumulations perspective. The next bullet point is inferior income riders. And this is a very common mistake. And it's justified because you might have 1,200 different options available, 1,100 different options available for an individual situation, for their age, for their state, if they're looking for joint income, single income, all those different things. So there could be mistakes along the way with going with an inferior income rider. Well, what's the problem with having an inferior income rider, an inferior product? Would result in thousands of more dollars being placed into the wrong area as opposed to being left over in your growth stage, your ancillary monies, really in your pocket at the end of the day, the end of the year. So like what I mean by that is, let's say, we need to complete a $20,000 income need, and we have company A that says, okay, we're going to require that this person gives $350,000 to us, and we'll produce a $20,000 income for them. Or you might have company B that says, okay, we'll produce this person $20,000 of income, and it's going to cost $200,000 with company B. Well, this just saved this person $150,000 that now they do not have to leverage towards an annuity account because they went with company B that was the same rate, the same rated carrier, could be even a better carrier because it was specific. It was this nice little sweet spot based on that person's age, based on the person's situation. That's where we really go to the drawing board. That's where we have an entire case design team that helps us run all these numbers to say, okay, what's your goal? What's the smallest amount of dollars, only as much as necessary to place dollars into that plan, whether that be an IRA account, Roth IRA account, non-qualified account, to make sure that you have as much leftover monies as possible so you win that retirement game. A third negative, variable annuities with income riders. Reason why I absolutely hate them, they're very expensive. You could have ones that could range between 2% to as high as 5-6% I've seen before, where your physical money is getting beat to hell. The income riders are not as high from a cash flow perspective as the fixed index annuities, those are the hybrid annuities. So, why would somebody place their money into that account? Because all they're doing is going with an inferior income rider. On top of it, if they want to leave a death benefit, there's a manipulation where you could tack on a death benefit rider into that account. But if, let's say, you drain down and your account balance hits $0, well, then nothing will get left over to beneficiaries anyway. So there's just different ways on how somebody could pack in a lot of fees. And there's a prospectus. That prospectus could be 200, 300 pages that it explains all those little fees in it. But it's such a complicated literature that an individual does not even know where the hell to look. And they just rely on the advice from that advisor. And the advisor might not even look through that prospectus. So that's where I've seen complete disasters with variable annuities with income riders. So just be careful on that. If you are set up with a variable annuity with an income rider and you want to just have a second look, maybe it might make sense to replace it or just get out of it altogether. That's something that we help individuals do. We run variable annuity stress tests and annuity stress tests to make sure that an individual could be, something that's more mathematically suited for their situation. And when I say mathematically suited, what I'm referring to is just trying to keep as much money in your own possession and place smallest dollars into these insurance-related accounts. The happiest clients that we have are the individuals that have a boatload of money in their ancillary dollars, in their growth-related accounts, because they're not caring if the market's going, it's ebb and flowing. They're happy when the market's up. They're fine when the market's down because they know that that's where they correlate. That's where they specified that goal is to say, okay, I could take some risk with these dollars. On top of it, when it's in the growth-related stage, you could go and splice that up into a few different areas. You don't just have to use investments for that. You could go use a portion of it, that's sitting into, let's say, low-cost mutual funds, low-cost index funds. You could have another portion that's sitting in safe accumulation accounts like a fixed index annuity. You could have them set up in, fixed-related accounts. You could have them set up in, individuals like to take those dollars, dabble in real estate. So that could be another portion of dollars. There's a whole multitude of different things you could do, but just making sure that, each one's sticking to its lane so that it's optimized most effectively. And lastly, what I'm going to constantly explain and beat into your heads is placing too much money into an annuity. It's not necessary to place all those dollars into the annuities, and that's where we constantly see those mistakes. Somebody has, let's say $500,000 sitting in a 401k account, and the advisor comes over, sits down with them, seems like a nice guy, and they're just saying, place everything into this annuity because it's going to give you, a 6% bonus, and we're going to give you some income and all this, which might sound great, but in reality, if it was an inferior product and you could have received much higher dollars, you put way too much money into that account. You could have placed less dollars into a better account and had more monies left over. So that's where the constant negative with these things is placing too much money. And rightfully so, you might see a lot of bad press about annuities, and I think they're justified because you have advisors selling them the wrong way. You have individuals that are understanding them the correct way. So when people are put into bad situations, they're going to complain about it. So that's ultimately, my 2 cents on why individuals put too much money into it, is I just feel like they're not properly educated on the pros and the cons. More importantly, the cons and the problems with these things. But if it's a good situation, get set up with it. If it's not ideal for your situation, then that's something you should not get set up in. And at the end of the day, it's just saying, okay, how can you, use these dollars the correct way? So in closing, if you found value in this video, feel free to give our 1-800 number a call. It's 1-800-566-1002. Some of the things that we deal with, we have a trademark process known as the retirement diet plan. The D in diet stands for distribution planning. The I stands for investment growth planning. The E stands for estate legacy planning. And the T stands for tax planning, making sure that all your areas, these are the 4 most important areas of financial planning, to make sure that all those different things are covered. Distribution planning could be more to some people than, the tax planning could, or estate planning could mean more than investment related growth planning. So, at the end of the day, it's just making sure that your bases are covered, that you're not going into retirement blindly, and you're confident with your retirement plan, confident that you could live a successful life throughout retirement, that you're no longer having to work, and able to reap the benefits of what you've accumulated for all those years. You can visit our website, retiresharp.com or fossilfinancial.com. It brings you to the same place. And also make sure to hit the subscribe button so you have access to the most updated videos. Thanks so much, guys.